Investing in the stock market can seem intimidating for beginners, but it is an excellent way to build wealth over time. With the right knowledge and strategy, investing in the stock market can be a great way to achieve your financial goals. In this video, we will provide a step-by-step process to help beginners in the US understand how to invest in the stock market. We'll cover everything from understanding the basics of the stock market to choosing a broker, opening a brokerage account, funding your account, and choosing stocks to invest in. By the end of this guide, you'll have a clear understanding of how to invest in the stock market and set yourself up for long-term success. Once again, this is Super Financial Tips, and before we move on, please like and subscribe for YouTube algorithm. Step 1. Understand the basics of the stock market. Before you start investing, it's important to understand the basics of the stock market. The stock market is where shares of publicly traded companies are bought and sold. When you buy a share of stock, you become a part owner of that company, and the value of your shares can go up or down depending on the performance of the company. Stocks can be divided into different categories based on their size, sector, and investment style. The value of a stock is determined by supply and demand, with prices fluctuating based on factors such as company earnings, industry trends, economic conditions, and investor sentiment. When a company does well and its earnings increase, the demand for its stock usually increases, and the stock price rises. Conversely, when a company performs poorly, demand for its stock may decrease, causing the price to fall. For example, large-cap stocks are stocks of large, well-established companies, while small-cap stocks are stocks of smaller companies with higher growth potential. It's important to understand the different types of stocks and their characteristics before investing in the stock market. The stock market can be volatile, and prices can change rapidly in response to news or events. However, over the long term, the stock market has historically provided solid returns for investors. It's important to remember that investing in the stock market involves risk, and there is no guarantee of profit. Understanding the basics of the stock market is the first step in making informed investment decisions. Step 2. Determine your investment goals. The next step is to determine your investment goals. Are you investing for long-term growth, retirement, or short-term gains? Knowing your investment goals will help you determine your investment strategy and the type of stocks you should invest in. Start by considering your financial objectives. Do you want to grow your wealth over time, save for retirement, or achieve a specific financial goal, such as buying a house or paying for your child's education? Your investment goals should be specific, measurable, and achievable within a certain time frame. For example, if you are investing for retirement, you may want to invest in blue-chip stocks that have a history of stable earnings and dividend payments. If you are investing for short-term gains, you may want to invest in stocks that are expected to perform well in the short term, such as those in the technology sector. Step 3. Choose a broker. Once you have determined your investment goals, the next step is to choose a broker. A broker is a company that provides access to the stock market and allows you to buy and sell stocks. There are many online brokers to choose from, including Robinhood, E-Trade, and TD Ameritrade. When choosing a broker, consider the fees, the investment options available, and the user interface. Step 4. Open a brokerage account. After choosing a broker, the next step is to open a brokerage account. This account will allow you to buy and sell stocks. The process of opening a brokerage account is straightforward and can be done online. Once you've chosen a brokerage firm, go to their website and follow the steps to open an account. You'll need to provide some personal information, such as your name, address, and social security number. You'll also need to provide some financial information, such as your annual income and net worth. You may also need to provide proof of identity and income. Step 5. Fund your account. Start by doing research on different brokerage firms to find one that fits your needs. Look for a broker that offers low fees, a user-friendly platform, research tools, and investment options that align with your investment goals. Once your brokerage account is open, you will need to fund it. You can fund your account by transferring money from your bank account, mailing a check, or using a wire transfer. The amount you need to fund your account depends on the minimum deposit required by your broker. Step 6. Choose stocks to invest in. After funding your account, you can start investing in stocks. As a beginner, it's recommended to start with blue-chip stocks, which are stocks of large, well-established companies that have a history of stable earnings and dividend payments. Some popular blue-chip stocks include Apple, Microsoft, and Coca-Cola. You can also invest in index funds or exchange-traded funds (ETFs), which are diversified investments that track a particular market index or sector. Step 7. Place your order. Once you have chosen the stocks or funds you want to invest in, you can place your order. You can place a market order, which will buy or sell the stock at the current market price, or a limit order, which will buy or sell the stock at a specific price. It's important to research the stock or fund before placing your order and to avoid emotional decisions based on short-term market fluctuations. Step 8. Monitor your portfolio. Monitoring your portfolio is an essential part of investing in the stock market. As you invest in stocks and other securities, it's important to keep track of how your investments are performing so you can make informed decisions about when to buy or sell. Start by regularly reviewing your portfolio to check how each of your investments is performing. Many brokerage firms offer tools that allow you to track the performance of your investments and monitor market trends. Use these tools to set up alerts for when certain stocks reach a certain price or when there are significant changes in the market. When evaluating your portfolio, consider your investment goals, risk tolerance, and time horizon. If your investments are not performing as expected, it may be time to make changes to your strategy. For example, you may want to sell a stock that has not performed well and reinvest the funds in a stock with better prospects. Alternatively, you may want to diversify your portfolio by investing in stocks in different industries or by adding bonds or other types of securities. Step 9. Diversify your portfolio. Diversification is an important part of investing. It involves spreading your investments across different asset classes and sectors to reduce risk. By diversifying your portfolio, you can reduce the impact of any one stock or sector on your overall portfolio. You can diversify your portfolio by investing in different types of stocks, such as large cap, small cap, and international stocks, as well as bonds and other assets. Step 10. Continue learning. Investing in the stock market is an ongoing process, and it's important to continue learning and growing your knowledge. You can read financial news, attend webinars, and read books on investing to stay up to date on the latest trends and developments in the stock market. In conclusion, investing in the stock market as a beginner in the US can be a daunting task. However, by understanding the basics of the stock market, determining your investment goals, choosing a broker, opening a brokerage account, funding your account, choosing stocks to invest in, placing your order, monitoring your portfolio, diversifying your portfolio, and continuing to learn, you can set yourself up for long-term success in the stock market. Thank you for watching.